Happy New Year, everyone, and welcome to 2025. However you celebrated, I hope you had a relaxing and enjoyable holiday season. And welcome back. This, of course, is the January 2025 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. 2024 was a great year for U.S. markets, with all of the major indices up by double digits. This was despite a weak December as investors pulled back at year-end on higher interest rates and rising economic uncertainty. The S&P 500 and Dow were both down in single digits for the month, while the tech-heavy Nasdaq eked out a modest gain. But internationally, the news wasn't as good. While markets closed the year with single-digits gains, a weak fourth quarter took those gains down substantially. With a stronger dollar and rising economic and military uncertainty, both developed and emerging markets showed small losses in December, capping a very weak fourth quarter. Fixed income also had a weak end to the year, with the aggregate bond index showing a small gain for the year after fourth quarter losses. The central factor in these results was rising long-term interest rates, which hit valuations across the board. The 10-year U.S. Treasury yield rose from 4.17% to 4.57% during the month, a significant increase, largely driven by new information from the Federal Reserve. Because in December, the Fed lowered interest rates by 25 basis points, which was expected. But what wasn't expected was the Fed showing fewer planned interest rate cuts in 2025, down from 4 to 2. That change means that the Fed remains cautious about both the economy and inflation, and that they'll be making decisions on a meeting-by-meeting basis this year. Despite all those concerns, though, the data showed that the economy continued to grow. The November jobs report had an encouraging rebound in hiring, which also drove improvement in consumer sentiment, with the University of Michigan survey up for the fifth month in a row. Higher consumer confidence typically means more spending growth, which should support the economy for the first half of the year. But while the positive economic trends are good news, the recent market turbulence should serve as a reminder that there are also real risks out there. Domestically, the primary risk is political. With the new administration in Congress, investors will be keeping a close eye on policy proposals. Internationally, we have two wars underway in Ukraine and the Middle East, as well as turmoil in allies such as France and South Korea. While the impact of these events has been limited so far, we do need to keep an eye on them, as well as whatever else might come up. Overall, though, we're still in a pretty good place to start the year. Market fundamentals are healthy, and analysts expect to see solid earnings growth in 2025. With a healthy economy, strong job market, and rising consumer confidence, that seems reasonable. And so the most likely path forward is for a good start to the year. And that's a good place to end this month's update. Thanks for watching, and please join me again next month for the latest news. As always, stay safe, stay sane, and stay healthy. And have a happy New Year.